What is up, YouTube? This is the Working Investor. Today we're going to talk about the high yield dividend ETFs based on options. Are they a scam? Is it a Ponzi scheme? Or you think it's real and we're living in the best generation that we have all these amazing funds at our disposal and we're able to catapult our retirement and be financially free super fast, much quicker than any other generation before us because of these incredible products. We're also going to talk about something called the emergency fund versus the emergency flow and why the emergency flow is far superior than the emergency fund, arguably. And finally, we're going to talk about why I like to use multiple different companies that use different fund managers, even if they're running similar products, and what my reasons are. So when I look at this crazy dividend tracker return, which is an estimate going into my projections for September, not August, because I do have a loss in August because when the market went crazy, I did a couple moves that at the time made sense, but now it doesn't look like it made sense. So for only $70,000, right? Which I am using some margin. They're estimating like 3,000 plus return in monthly income, which I think it's more like $2,800, but I don't believe it. But we'll see in September. But it's insane. Look at the yield, 60+% yield, or yield 60.72 yield on cost. The numbers are a little off because I did a couple maneuvering with a couple shares plus or minus, but it's pretty close. This is nuts because that means that whatever your income is, if that's what you're relying on to live, if you would just save up hypothetically, theoretically, I'm not telling you to do this, 2 years worth of income, if you're making a 50% return. When I say 50%, because you have to think of NAV erosion, net asset value erosion, so your total return is probably a little less. If you're eroding 10-20%, you have to take off 10-20% of 60%. So even 40% return is insane. The average stock market, return is of the S&P 500, it's 8-12%. If you're talking about 40% net return, it's mind-boggling. Past performance is not indicative of future gains. I got to put that in there. So yeah, technically you just save up 2 years of your income and then pretty much you replace your income. And then if you're not happy with your job, you can just, it's your it's your freedom fund pretty much. You can go and then you can just pursue whatever you want to pursue, whatever kind of career, company, business, or life you want to pursue. It's crazy. It sounds too good to be true. So because when you compare this to your classical McDonald's and your Walmart and your Coca-Cola, Pepsi, Johnson and Johnson, Procter and Gamble, fill in the blanks, whatever, tried and true dividend company, those value companies, they're giving you in the single digits mostly, or the low single digits, like 5% or less for the most part. And these companies, they're giving you 10 times that amount or more. So, of course, I'm thinking to myself, this is too good to be true. If something seems too good to be true, it probably is, right? But maybe not, because I've been doing options for a number of years now, and I've definitely seen returns, in these ranges, or close. And somebody one time asked, I'm not sure if you guys know who Tom Sosnoff is. He's one of the leaders, one of the founders of Tasty Live. And Tasty Live is one of the leading in the industry of options, futures, trading. I think, their team actually invented Thinkorswim, which is an amazing piece of technology that people used in TD Ameritrade, now merged into Charles Schwab. And they're so I definitely value, and they do a lot of research and back testing, and I definitely value Tom and Tony right there. I value their opinions. And a caller once called in. I was listening to one of their shows, and he asked, hey, what's the what's an expected return for an option premium seller? I mean, obviously it depends. It's very nuanced, but he was saying, in general, depending on your deltas, obviously, and your risk appetite. He was saying 24, I can't remember exactly, it was somewhere in the 20s to 30%, low 30s, high 20s, mid 20s to low 30s, we'll say, percent return conservatively. which is incredible. It's like double the S&P 500 average return, because of course there's been some crazy years. Um, so and also, as running options myself, I definitely see that there is possibility in these products that we have from YieldMax, from Defiance, Roundhill, CraneShare, a lot of these other companies, fill in the blank. They're based on options. We're living in one of the best ages where you have all these choices and varieties of funds that we did not have, 10, 20 years ago. And even if you're not an amazing seasoned option trader, you can enjoy the returns of it. Of course, to actively manage, they do have, there is, expense ratios, fees you got to pay for it. But yeah, it's nuts. So yeah, we're living in such a crazy generation. But again, you have to be careful because markets could change, volatility can change. There is a lot of risk with options too that you don't have with underlying stock. So yeah, so I think it is real, but you gotta tread carefully. We'll talk about emergency fund versus emergency flow. Emergency fund is what you think about, like, it gets depleted, you have to refill it with your paycheck. It has a limited amount of money. It's limited because it's limited in duration of safety. If you save up 3 months supply of life costs, cost of living, if something ever were to happen, job loss, changes, illnesses, accidents, catastrophes, you got yourself a 3 month buffer. But if you have an emergency flow, let's say, if let's say I have a $3,000 ish flow, if that's enough to cover my expenses, then it just replenishes hypothetically every single month, which gives you, like, it's almost like having, it's like extra insurance. People probably, and there's some good products out there, like, life insurance, health insurance, even your car insurance covers for certain accidents. There's, again, I'm not an insurance broker. There's long-term disability, short-term disability, all kinds of stuff. But you have to argue that having those products are awesome, and then having this extra flow of cash coming in every single month just gives you another layer of buffer, another layer of security, and there's no definite end date. It just keeps on going as long as the funds are still in existence. So that's why, like, I feel like the cash flow is far, far, far superior than an emergency fund. An emergency flow better than an emergency fund, though an emergency fund is definitely important as well. And also, I want to talk about, like, diversity, especially talking about diversity of using different fund managers, because we all know, like, when it comes to options, there's diversity in underlying, like, what assets, is it commodities, is it based on the S&P 500, is it based off currencies like Bitcoin, gold, or other currencies different, the yen, Japanese yen. And then there's, like, the strike price, expiration, the delta, beta weighted returns. There's, like, bullish. What kind of strategies? Diversity. You can have the same underlying, but you're using different strategies. Is it a bullish strategy, bearish strategy, neutral strategy, bullish-ish leaning, bearish leaning, right? And finally, there's also something called diversity in the fund manager, because even if you have two identical funds, right? It's not like these classical funds, where, like the Vanguard funds, where it's all about allocation, rebalancing, and whatnot. So you just kind of set it, forget it, and then just rebalance it. And they could charge you an expense ratio of 0.03%. I've seen even 0.02% expense ratios. These are funds that are being actively managed. Like, for example, like, QDTE, XDTE are like daily options, options on futures that are done every single day. They're literally moving things around every single day. So becomes more and more and more paramount and important to have good fund managers, and maybe even a diversity of fund managers, because you can have two people that are brilliant, but one person they have differences of opinions. So that's why I've done some Roundhill and some YieldMax. I'm diversifying out a little bit. Even if it's similar products, I'm diversifying in price, also diversifying in fund managers as well. Also, like, being the smartest person doesn't always make you the richest person. They always say, like, people with the C students are like, the A students are getting their, for C students. I heard somebody say, I have 2 PhDs and 7 master degrees. Like, really? No, I have 2 people that work for me that are PhDs, and I have 7 master's degrees working for me. So, so basically, being smarter doesn't always mean you can have analysis paralysis, overthink things. being bold, having also a lot of your, the mistakes that I've made. One of the reasons why, emotional intelligence is important. The stock market is not just mental; it's also like emotional. You know what I mean? So, for example, like I had TQQQ, and I have like three leap options in TQQQ. I opened my third one to lower my cost basis, but I had to sell for $3,000 loss a cash secure put. In it. I also sold an Nvidia cash secure put when the market had a freak out on August 5th. So, making decision making capacity, makes a difference. So that's, again, just getting off my soapbox, why it's good to have a diversity of fund managers. That's the point I want to bring home. Anyways, I hope you guys have a wonderful weekend. Hope you guys are doing well. Again, this is not financial advice. This is just a retail investor sharing my 2 cents, just getting some thoughts out there, just to open some conversation up. Stay healthy and stay wealthy.